Now, part B of the question is asking you to carry on with what you've just done and calculate Darren's income tax liability. So what we need to do is put this income that we've got up here into his income tax comp, not forgetting that we've also got his property income that we've worked out. So his salary is his non-savings income. He's got savings income from interest and dividends, which falls into dividend income. And then don't forget his property income will also be treated as non-savings. So let's put this into our table then. So part B, non-savings, savings, dividends, and total. So let's copy his income in there. So he's got his employment salary. And we're not too fussed about what descriptions you use for these. The main thing is that you put in the right number in the right column. We've got his property income, which is his 29,608. I'm just going to highlight that so we remember that's what it is. And in the exam, you know, if you've got a different figure in part A, as long as you carry your answer into part B, you will still get all the marks. So don't worry about, you know, is part A right or not. It doesn't matter really. All we're doing is testing that you understand where your figure goes and how to tax it. So he's got his interest in the savings income column. And he's got his dividends in the dividend column. Okay, so let's add that up, see what we've got. So we've got 65,608 in non-savings, bit of interest, bit of dividends, and that gives me a total of 72,208. Now, once you've got this total figure over here, I would always look to see what amounts you're dealing with. All right, remember this is what you use to test to decide if somebody gets, for example, their personal allowance. You know, do they still get the full personal allowance, or they beyond the point where it's being withdrawn? Or what level are they to get things like their savings allowance? So this person here is earning above 37,500 in total for gross income, and therefore would be classed as a higher rate taxpayer. So they're not going to lose their personal allowance. So we're going to deduct that from their non-savings income, which we'll always do as long as there's enough to deduct it. If there isn't, then, you know, move across and deduct it from the savings or the dividends. And that gives me my final taxable income of 53,108. Remember, this is very much on own figures, because if that property was wrong, then obviously this is going to be completely different as well, but we're not going to penalise you twice. If you did get a question where somebody had their personal allowance withdrawn, I mean, let's say that was 172,000, then they're not going to get a personal allowance. But just put it in a zero or make a comment that they're not going to get it. Don't just ignore it. You know, say that the personal allowance is going to be given or not given in some shape or form, either with the numbers or with some explanation. So just like we comment on exempt items, you need to do the same with these personal allowances. So we're now going to work out the tax. So we're going to start with this non-savings column first. We can see here that figure goes above this 37,500. So the first 37.5 is going to be taxed at 20%, which gives me 7.5. And then the rest of that 53,108, which is the balance of 15,608, is going to get taxed at the higher rate. And don't bother with pennies, you know, just round it. I mean, strictly we always round down, but in the exam we don't care really, as long as you've got rounded up or down. Just don't bother with the pennies. You haven't got time to do that in the exam. All right, so that's the tax for your non-savings income. So we're going to move across to the right, and the next income we've got is the savings income, this 400. Now, if you've got savings income, you will get that savings allowance unless you're an additional rate taxpayer. Now, the amount you're going to get for your savings allowance, let's write it in, is going to be 500, isn't it? because you are a higher rate taxpayer. They're earning above 37,500. So as we can see, their savings income is only 400, so there is no tax to pay. Right, I can't have relief on 500 because I haven't earned 500, but I've got 400. It's below the allowance limit, so there's no tax to pay on my savings income. Okay, so that's your 400. And the final one we've got then is this dividend income. So dividend income, we get that dividend allowance of 2,000, and everybody gets that regardless of what their level of income is. So 2,000 will have no tax to pay, and the rest of the dividends, so we've got 6,200 altogether, the rest of it will be taxed at 32.5%. Now, if you're not sure where this 32.5% has gone, all right, think about what's happening here. You've already used up your basic rate band, so you can't tax your dividend at the lower rate of 7.5%. You're now in this middle band, classed as a higher rate earner. So that means any income you earn is going to be taxed at that middle rate, which for a dividend, the middle rate is 32.5%. So finally, we add it together, which will be very much your own figure if you've got different numbers, obviously. And the tax should be 15,108. Now, a lot of you would probably stop at that point, but what we have got here is something called a tax reducer. Now, there are really two types of tax reducers you might come across in your exam. The one we've got here, which is with a mortgage interest, and the other one where you've got your personal allowance being transferred between your spouse. So if you give some of your personal allowance away, or you receive some of it from your spouse because they haven't got any income to use their allowance against, that would be another example of a tax reducer. So this is to do with the mortgage interest. And if you remember, the interest was 2,000 on, what was it, property 33 Green Avenue. Do you remember this up here? So we had that mortgage interest there. So we claim 25% relief against property income. What we're getting is the other 75%, we're getting relief against the tax. So the other 75%, the other 1,500, we don't get relief for 1,500, but what we do get relief of is at the tax rate of 20%. It doesn't matter that we're a higher rate tax earner, the relief is always at 20%, and the same would be with your married couples allowance. So you don't get any more relief just because you pay more tax. So we reduce it by £300, and that ends up with my final tax liability for Darren of 14,808. Now, if we just finish off with part C of that question, briefly describe the main consequences if Darren had given 59 Argyle Street to his daughter rather than sell it. So I don't know if you remember doing this when you did capital gains tax, but the daughter is classed as a connected person. A connected person is usually, you know, close family, parents, children, grandparents. And if you transfer to a connected party, regardless of whether they pay you any money for the asset, you treat the sale at market value. So what Darren would have to do is he would ignore the actual proceeds of selling the building, and he would use the market value at the date of sale, and then he'd compare that with the cost to get the capital gain. So the fact that it was a gift suggests that, you know, he gave it to her completely free, but that would be ignored. So Darren would still pay tax on what he would have sold it for, even though he might have given it away to his daughter. The other element, which you won't be familiar with because we've removed it from the syllabus for this year, is the IHT, inheritance tax. If you transfer to a person, so if an individual transfers anything, this can be assets or money, to another individual is classed as what we call a PET, potentially exempt transfer. And that means it's exempt from IHT when the transfer takes place, and it's exempt at death if the transferor lives 7 years. So in this example, that would mean that if Darren survives 7 years after giving that asset away to his daughter, then his daughter will never pay any inheritance tax on it. If he doesn't survive 7 years, it might be subject to inheritance tax. We're not saying it will definitely be. We'll have to see what the rest of his wealth is at death. But once it goes past 7 years, then you're all home and dry. There's no inheritance tax to pay because you don't pay anything at the transfer date and you don't pay anything at the date of death. But if he dies within 7 years of the transfer, it's classed as part of his estate when they look at the IHT. So you won't be aware of that unless you've read the IHT chapter, so I don't worry about that too much, but I would expect you to know this bit here, that for capital gains purposes, if it's a connected party, ignore any actual proceeds, or in the case of this, there isn't any, and then just look at market value at the date of sale. So hopefully you found that debrief useful. All right, question 1 is always going to be something to do with income tax, looking very similar to this. It may not be like you've got here where you've got to do property income and then the tax liability. It might be a question where, say, you've got to work someone's employment income out. So it might be somebody who's got a couple of benefits. So you work out their employment income and then you use that information to work out the income tax liability. But it will look very similar to this. Calculate something, put it into the tax comp with some other numbers, and then a tiny little bit of theory at the end.